Hello and welcome to another webinar with me, Aaron Hill, one of the market analysts here at FP Markets. Thank you all for taking the time out of your day to be with us as we deep dive into the concept of divergences, a tactic that can and yet can complement one's trading methodology. I take it we can all hear me clearly and see the welcome slide. If not, please do let me know in the chat box. Just a simple Y. Guys, can you just, if you could, just let me know Y or N in the chat box? That would be fantastic to know I'm coming across loud and clear. Okay, so look, the session will be recorded, and as usual, thanks, guys. The session will be recorded and as usual and is available through a number of avenues, including our FP Markets YouTube channel. If you can just bear with me just for a minute, I just have to run through the disclaimer. The information contained in this material is intended for general advice only and does not take into account your investment objectives, financial situation, or particular needs. Really, all this is really trying to say is this is not investment advice. It's solely for educational purposes. Always take care to conduct your own research in your trading process. So what we're looking at in terms of topics is defining what divergence is, and identifying the different divergences in terms. So we have regular and hidden divergence, and then we're looking at how we can incorporate divergence into our trading strategies. And then, as usual, we'll try to round things off with a Q&A session. Any questions I miss? First of all, I am willing to take questions as we progress through the presentation, as long as they are relevant to the topic at hand and to avoid confusion and diverging too much. Look, any questions I miss or do not have time to address, please consider emailing us at marketanalyst@fpmarkets.com and we'll reply as soon as possible. Also, please use this email to send over any suggestions for any topics you'd like us to go over in the future. So what is divergence? Leaving fancy wording aside, divergence can be best defined as a situation when the security moves in a different direction to that of an indicator. A divergence signal helps locate positions on a chart where shall we say price movement is deceptive, with the indicator demonstrating that the price move is perhaps not as strong or as weak as it appears. For me, this is a fantastic tool and is something we should all have in our trading arsenal, as it helps determine reversals as well as continuation signals. Now, as a quick demonstration, if the price of a security chalks up a fresh higher high, which, as I'm sure you're all aware, is seen within movement to the upside, but the indicator does not confirm this and forms a lower high, it provides us with what's known as a divergence signal. So divergence in this screen, divergence on this slide is labeled as bearish divergence and signals that buyers could eventually be losing steam. Now we have a comment, just bear with me. Hi, your slides are not appearing on my screen. Guys, can you just confirm, is everyone else seeing this slide? So currently I have what is divergence and I have some pre-drawn lines on the slide. No, okay, just give me a second there. So you're only seeing my face. Okay, sorry about that. No slides so far. That's terrible. Okay, just give me a second. How about now? It should be just why. Yeah, brilliant. Look, I'm really sorry about that, guys. It seems to be a problem with GoToMeeting at the moment. This is who we use. I'm not sure what's. Let me just check the previous slides. Yeah, so literally we haven't really missed anything. All I went over was the presentation topics, as you know, divergence, regular hidden divergences. We're going to look at them and how to incorporate these into your trading strategy, along with a Q&A session. Let me just spin through to where we was. Boom, boom. Okay, this is where we left off. So yeah, apologies for that. So if I just quickly run over this again, because it would, that was a bit of a diverge. It certainly was. Right, so look, what is divergence? Just quickly, I'll go over this again so we all know where we are. As you can see, this is the securities price, and we have formed a higher high. However, on the indicator, we have formed a lower low. What this is telling us is we have what's known as a divergence, and in this case, we have a bearish divergence. What this is showing is, although price has formed a higher high, we are seeing the potential for a possible reversal to the downside, a reversal or a small move. It could just be a small move in terms of just a dip. But what the indicator is showing is that we have a lackluster upside, I think is the best word to use in this case here. So just to recap and ensure we're all on the same page, divergence is when the price of a currency pair, assuming we're talking FX here, moves opposite to that of an indicator. So what does divergence show? Divergence essentially offers traders and investors a red flag, showing us when a trend or a prolonged move may be weakening and gearing up for a turn. As I said in the previous slide, gearing up for a turn, this could be a reversal or it could simply be a dip in price. I emphasize the word may here, as nothing is 100% in trading or investing. Traders who have used divergence techniques will know there are two types of divergences. There is the positive divergence and negative divergence. So look, the positive version simply shows that a move higher could be on the cards, while negative divergence highlights a move lower is possible. Traders, however, commonly refer to these as simply bullish and bearish divergence. So bullish divergence equals positive divergence, and bearish divergence is negative divergence. We have a question here. So are you saying the indicator direction trumps the price direction? I certainly am. That's a question from the kid. Yes, I am, especially in terms of the RSI. As I'm sure most of you will be aware, momentum often precedes price. And that's why I believe the RSI is a good leading indicator when you're looking at divergences. Okay, so moving on. To help solidify our understanding of the concept of divergences, the image on the screen I think does a good job of depicting the variations you will see when pursuing divergence. So the middle of the diagram highlights bullish divergence variations, while to the right we have bearish divergence. And as you can see, this lists the different types of variations. And to the far left we have price oscillator. So and then we have the a strong, moderate, and weak versions. And also I'm going to touch on what's known as hidden divergence. So I just want to ask a question. How many of us here actually use divergences in their trading? What's their experience been like? And have you noticed any nuances with any indicator that you would want to highlight during this presentation? If you could just type in the chat box, that would be great. While you're doing that, I'll just quickly run over what this diagram shows. Only when it's really apparent. Yes, I agree. That's the best. They're the best type of signals, as I hope you'll see here. So I've labeled this, as I said, strong, moderate, and weak versions of divergence signals. So for bullish divergence, we are looking at a defined lower low and a defined higher low within the oscillator. Now, this gives us what's known as bullish divergence, or if you remember, positive divergence. As for the bearish divergence, it's simply the mirror opposite. We form a higher high in the price, though the oscillator shows us a lower high. Now, all this is doing is measuring the strength of price, measuring the strength behind the price movement. So we have a lower low, but how strong is that lower low? How strong is the conviction behind the bears of this move? According to the oscillator, at current price, at this area here, it's not that strong. Does that mean that price will not continue to the downside? It most definitely does not. As I said, there's no 100% guarantees in anything in trading or investing. So we move to the moderate version. Now, some traders will say that moderate and these two versions are very, very similar, and I would agree. The difference here is price forms a moderate lower low, while for a bullish divergence, and the price action for a bearish divergence forms a moderate higher high. That's the only difference. Now, some would even say this is a stronger version, as the oscillator depicts a very similar presentation to the strong version. Now, what we have here is as I said, a moderate lower low and a moderate higher high. So what this shows is price has not been able to get past the lows to, has not been able to explore much territory below previous lows for a bullish divergence, and for a bearish divergence, the same. We've not been able to explore much territory above prior highs. Now, as I said, this could be labeled strong as well. This is just something I've seen in my experience of using divergences, and have labeled it moderate. As the reason for this, the reason for the strong label here is because I tend to see the more defined moves with price and the more defined moves with the oscillators tend to have the better odds of working out. Whereas when price is producing moderate price action, I don't really tend to see much emerge from these signals. Now, the weak version, as I'm sure you can see, price can form either the same scenario as the moderate version or the same scenario as the strong version. The only difference here is the oscillator. As you can see, I hope you can see, the oscillator has not produced much in the way of a defined higher low or a higher high. It's more in this version here, it's more of a double top for anyone that follows price patterns. So with me, I always look for the strongest version to form before I consider a trading opportunity. And yes, so I would always look for the stronger versions in terms of and just to be clear, these three sections here are regular divergence. They are not, and with that, we're going to move on to the hidden divergence. So we have bullish divergence and bearish divergence for hidden versions. Now, the reason I believe these are labeled hidden is simply because many I don't really want to say the word uninformed, but many newer traders will not be looking for this. Now, bullish divergence is essentially where price leads the oscillator. So as you can see, for a bullish divergence, price forms a higher low. But with that, the oscillator forms a lower low. Now, what this is telling us is that the oscillator, although that, let's keep it to momentum for now, because that will be the main gist of this this presentation. So imagine we're looking at, this is the RSI. We're looking at momentum studies, and the oscillator has formed a lower low. What this is telling us is that momentum is gaining to the downside. However, price is not agreeing with that, and we formed a higher low. What this is saying is that price is essentially leading the action right now, and if we form a higher high, high from this point, momentum is to the upside. So hence why it's called hidden divergence. Now, the points to note on this. Remember, regular divergence is more for reversals. So these sections here are more for reversal signals, whereas hidden divergence, in my experience and other traders I speak with, is generally seen as a continuation signal. So with the, okay, we have a question here. Hidden divergence works better with the MACD. I don't think so. I'm sure you're aware the MACD is also a momentum oscillator. So although it's a combination, the MACD, isn't it? It's a combination of a trending tool and an oscillator. But if you put the two on the screen together, you'll see very, very similar signals. At least in my experience, has been the case. But the hidden divergence, I would not say it works better with the MACD. I would say it works very similarly. But for me, I've always preferred the RSI, as that's what I began my trading with, and that's what I know inside and out. Yeah. So look, as I said, let me just repeat that. Regular divergence is used for reversal signals. Regular divergence equals reversal signals. Hidden divergence is generally used for continuation signals. Remember, as I've already said, divergence is not a guarantee price will reverse or continue. There is nothing in trading that tells us we're going to be 100% right on this trade or that trade. It's also important to be consistent with your markings. What I mean by this is if you mark up, say, a bearish divergence and you use two clear higher highs at this point here, you have to use the corresponding high and lower high on the oscillator when looking for a bearish divergence. There's no point marking over here if you're using this high here. I hope this would be obvious, and it would make little sense to do that anyway. So basically, the highs and lows you identify on the indicator must be the ones that line up vertically with the price highs or lows. One final point, there's also a concept known as double divergence or even triple divergence, I've heard, which is simply where price forms consecutive high and low points, as does the selected indicators. So just as a quick example here, if I can annotate this, just bear with me. So the indicator is, so I'm going off the bearish divergence at this point here. So the indicator has formed consecutive higher highs. Well, sorry, this is the price. This is the price movement. This goes here, price movement, and this will be the oscillator. So with that, we're forming lower highs, and lower highs. Okay, this is a concept known as double divergence, or in this case, triple divergence. This is just something to look out for. I've seen work a number of times if you're looking out for this kind of thing. Let me just erase those. Okay. So are there any questions on this slide before I move on? We've had one question from someone asking whether hidden divergence works better with the MACD. Are we all clear between the difference of hidden divergence and regular divergence? We have another question here. Can you touch on how stochastics stack up with the RSI when divergence occurs? We mitigate risk by applying patience and identifying correlations across indicators. Whoops, I've lost the question. Does the stochastics align with the RSI action during strong divergence versus price action? Now, for something like that, you could look at that yourself, but with the stochastics, the MACD and the RSI, they're all momentum oscillators. So they're all going to show very similar pictures. In my opinion, this is just my opinion, guys, and you may disagree with this. I don't see the point in having the MACD, the RSI, and the stochastics on one chart. I really don't see the point in that, because they're essentially measuring the same thing. This is just my opinion. Yes, you may see something appear on one indicator at times that you don't see on the other indicators, but overall they are measuring the same thing. So I just tend to stick with the RSI. So as your question, how does the stochastics stock up with the RSI when divergence occurs? I would say they're very, very similar. I haven't really back tested that, but you will see this if you put them on the charts. They do give very similar signals. So you'll also ask a question here: does the stochastic align with the RSI action during strong divergence? I would hope so. I really would hope so. But for me, the RSI is king for this kind of thing, for divergence, especially for momentum studies, I might add. So any other questions on this slide? If not, as I said, please do take a screenshot of this slide if you want to study this in your own time, or failing that, you can email me at marketanalyst@fpmarkets.com, and I will send you this slide via PDF. Where can we locate divergence? As far as I'm aware, almost all indicators we look at as traders can be used to find divergence. However, as I've said already, to kick things off, I think it would be a good idea to look at the relative strength index, and this focuses on momentum divergence studies. Now, this is a very popular index and is usually applied to the bottom of one's chart in a separate window, or I've known traders to use it at the top of their chart as well. Regardless, it's usually a separate window on your chart. Now, I won't go into too much detail here, as my colleagues and I have held webinars on the RSI in the past. So please do check these out if you want to further understand this indicator. Now, as you can see, the RSI was created by a chap who goes by the name of J. Wells Wilder in 1978. And what it does is measures the strength of your traded market against the history of price changes by comparing the up and down days. Now, 14 periods is the default setting, but traders do adjust this to suit their trading style. So a lower period will increase the indicator's sensitivity. So this could be a period setting of 10 or 8. And a higher period will obviously reduce the sensitivity. So we could go for something like a 20 or 30 period setting. The RSI is not to be confused with relative strength studies, now which involves simply dividing a security by a benchmark like the S&P 500. The RSI is solely focused on the market you're performing the analysis on. So knowing that the RSI measures the, shall we say, the velocity of divergence of directional price, the velocity of directional price movement, and it's shown by a way of a value between 0 and 100. I understand you cannot see 0 and 100 on here, but this is how the indicator is displayed. It's important to note that the indicator is calculated based on closing prices. And this is where, and it's important to understand that this is where we draw our price lines from. It's never the candle extremes. I've seen so many traders draw from candle extremes to locate divergence. This is not the case with the RSI indicator, and I would assume this is not the case with the MACD as well, because that's measured on closing prices based on the EMAs. Generally, for me, I consider the RSI to be a fantastic leading indicator, particularly when looking at divergent signals. An important point to make on the RSI then is momentum, as I said earlier in response to a question, often precedes price action. Now think about momentum as the speed of price change. For example, if we have a handful of traders buying into a market and price advances, more traders see this movement and trade. Consider momentum-based strategies in particular. And before you know it, we have a strong wave of bullish activity. So the question most traders and investors ask is, how long will the market remain in this state? So are buyers going to are going to run out of fuel or overheat, so to speak? So look, prices cannot rise continuously, and prices really, although they can continuously drop, but it's rarely seen, especially in the FX market. I've never seen it. I was thinking more of stocks where it can go to zero. But look, prices generally cannot rise or fall continuously. And this is where the RSI can be a handy tool to have in your arsenal to help decipher this movement. So here we can see two examples of regular divergence in play. You may remember from the slide, these are what I would consider strong versions of regular divergence. So as you can see, the RSI indicator has performed a higher low at this point here. And as you can see, I have drawn from candle close to candle close to highlight a bullish divergence in the price movement. Now, as I've said, this is, as you can see, these align perfectly with the lows and highs of the price and indicator. This is a bullish divergence. Now, all this shows is the price move to the downside is somewhat lackluster according to this, lacks strength according to the RSI indicator. Now, if we move over to a bearish divergence version, we can see that price did indeed form a higher high. But what I've done is I've marked from candle close to candle close. Now, as you can see on the oscillator, on the RSI oscillator, we have formed a lower high. Now, what this is showing is price is currently being reasonably deceptive in that although trend traders will see this as a higher high and potentially look to buy any dips, we could be in for a larger move than expected, according to the RSI oscillator. Any questions, please do feel free to fire away as I progress through this. So look, one point I feel I need to make with the RSI is I found over the years is that divergence signals, in particular regular divergence signals, are best located around overbought and oversold areas. And so the overbought area is located between the 170 mark, this white shaded area, and the oversold area is located between 30 and 0. So how do we incorporate this into our trading? And this goes for any other indicator. This can be for a volume indicator, which we're going to touch on next. How do we incorporate this in our trading? Can we just trade solely off of divergence signals? I would highly recommend you not doing that. I always look at these as confirmation signals rather than isolated signals to trade. So looking at this version here, we can line the bullish divergence up with a reasonably, this is not a fantastic support and resistance level, I understand that, guys, but this is a resistance turn support that aligns with our bullish divergence. What I'm trying to show here is that you should be looking for confluence around the divergence signal. Here we can also see we have a trend line support, again, converging with our line of support and the bullish divergence signal. And as if you remember, this is around the oversold area, so this is quite a high probability divergence signal. Excuse me, guys. Okay, so we can also, with this, we can also show that for anyone that uses moving averages, we can also use dynamic support and resistance through a moving average. Look, while moving averages are used to help smooth the underlying trend, and they're also employed in mean reversion systems, and at times, as we see here, they can help deliver dynamic support and resistance depending on the direction you're trading. So look, here we have support converging with trendline support, converging with an MA dynamic support, along with a divergence signal, a bullish divergence signal. I hope that's helped clear up any a way of incorporating this into a basic system. I've just noticed another bearish divergence over here from candle close to candle close. You can see here, the only difference is, let me just mark that up so we can all see. So we have a price forming a higher high here. As you can see, I've marked from candle close to candle close, and we have the indicator forming a lower high. But do note that we are not within the overbought area. So this is something that we should be aware of. Let me just erase this. Whoops, just give me a second. Okay, right. So I think this would be a good time to introduce how the art of confirming divergent signals. So as we all know by now, the RSI divergence occurs when the relative strength index starts reversing before price does. Essentially, what this is telling us is the average gains are beginning to exceed average losses. This is in terms of a bullish divergence. So I'm just trying to think of the best way to explain this. So look, let me try and repeat this. So when the relative strength indicator begins reversing before price does, what this shows is that the average gains, this is in terms of bullish divergence, the average gains are beginning to exceed average losses. Now, I do want to emphasize the word beginning because it's not actually exceeding the average losses at that point. So this is a very important point to note, as according to the indicator, average gains do not exceed average losses until the actual RSI value comes above the 50 center line. Again, this is if we're talking about bullish divergence. Anyway, knowing that momentum effectively precedes price, how do we go about confirming divergence? One thing I will stress is the word confirm here. It could probably be modified here, as you can never confirm anything 100% on or any signal in the markets. It's just not possible. However, you should do everything you can to verify you have a legitimate divergence trading signal before taking a trade. The first thing, of course, as I've said earlier, you can look to locate divergence signals in overbought or oversold space. So as I said, the overbought space is between the 170 values, and the oversold is between the 30 and 0 values. We can also look for a pattern known as RSI failure swings to form following a divergence signal. I go into detail regarding these in the RSI webinar, so please check that out if you're interested. However, just as a quick demonstration, an RSI failure swing, as you can see, is marked on the, so let me just go over a bullish formation. So we see the RSI indicator dive into oversold territory, and we form a subsequent high and then a subsequent higher low, which does not penetrate the oversold value, and then subsequently breaks the previous high. Now on this break is where you get your bullish signal, hence the term RSI failure swing, because it's failed to push lower. So you can use this break of the previous swing as a means of confirming the divergence. Obviously this will get you in later. That's the balance you have to weigh when you're looking for confirmation. Another way of confirming RSI divergence is simply looking for support and resistance on the RSI indicator itself. Like the MACD, and I believe the stochastics as well, you can use traditional technical patterns on the RSI to help add weight to the signal. We do have a question. Just bear with me. I'm trying to locate the question. For some reason, Rex, I can only see part of your question. What are your settings with the RSI? Is that the question? What are your settings with the RSI? So for here, the settings are, I always use the default settings. This is 14. But as I said I think it was near the beginning of the presentation, if you want to increase the sensitivity, you simply lower the setting. So the default setting is 14, so you could lower it to 10. You can lower it to 10 or 8 or something like that, or to or you can use the or a higher sensitivity value of 20, and that will decrease the overbought and oversold signals. Okay, just before I get off on this, get off from this slide, we have a comment, a reasonably long comment from an attendee. Disagree on not having RSI plus stochastics on the same chart. RSI is the leading indicator, yes, agreed, but the stock will provide more cycles to identify when the RSI is getting to final extreme for reversal. Really helps with timing, confirmation to enter a trade. RSI cycles once, but stochastic will cycle 2 to 3 times. Yeah, so look, I think we're going to have to agree to disagree on that one, the kid. I've seen no benefit from having 2 momentum indicators on the same chart, unless you're using them on different time frames, then I would agree. If you're using the MACD on, say, the daily time frame, or the RSI and the RSI on, say, the H1 time frame, then yeah, I would say that the having 2 momentum indicators is something we could work with, but having 2 momentum indicators that basically show the same thing on one chart is not something I would recommend. Okay, thank you for your comment though. Okay, on to volume. Volume indicators are technical tools to evaluate a security's bull and bear. But let me just add a comment to that last comment there. That's not to say that what you're doing is wrong. Let me just confirm that. We all have our own trading strategies and our own our objectives. So if that works for you, more power to you. I've just found it doesn't really work for me, and that's all I was really saying with that. So on to volume. Volume indicators are technical tools to evaluate a security's bull and bear power, as I've just said. Most volume indicators look specifically at buying versus selling pressure to determine which side is in control. So in the stock market, volume is traded. So volume is measured by how many shares are traded. In the futures market, this is all to do with contracts. So volume is calculated by the number of contracts bought and sold, and I believe that's the same with the options market. I've never really traded the options, but I believe that's the same thing. So the forex market, the spot foreign exchange market, is a different animal. Although retail speculators would expect volume to represent the number of lots traded, the majority of CFD and CFD-FX brokers usually display what's known as tick volume, which means the number of times price moves or ticks up or down. So volume data on most MetaTrader 4 and MetaTrader 5 platforms are broker fed and will therefore offer just tick volume. It's important to understand this. So a tick in forex trading is the smallest possible unit. By which price movement can change. It's often called a point. So we can say 1 pip is the equivalent of 10 points or ticks. Now, as far as I understand things, a tick does not refer to one individual transaction. What a tick is referring to is a price move that takes out all the willing offers at the next tick above to form a tick, a 1 tick move higher. I hope this makes sense. This should make sense from an order flow perspective. So it may take hundreds or thousands of transactions to move price through the liquidity above before a new tick forms. So think of a tick, boop, it ticks up, it takes out all the liquidity above. So in terms of liquidity, I'm talking about offers, or the offer price. So willing sellers. So if anyone knows any different to this, please do let me know, as I would be interested to hear your opinion. Okay, more on volume. Briefly, just let me go over the conventional volume interpretation. these are the observations that are traditionally followed. So as you can see, volume is rising, price is rising. This means volume confirms price. A rising volume with a falling price tends to confirm a price drop. Now, this is where we get into the divergence area. So price is rising, but the volume is falling. Just think of this as a regular divergence. Volume indicates a weak rally, as the RSI does. If the indicator in this case, its volume is falling, but price is rising, as you can see, volume indicates a weak rally. When volume is falling and price is falling, volume indicates a weak pullback. So there's little strength to the downside. Any questions on this, guys? Please do feel free to let me know. So with this information under our belt, can we use volume or for spot FX, tick volume as a form of divergence? I'm sure most of us here will recognize we can, and many successful traders do watch volume studies, either through traditional volume bars or a volume indicator applied to the lower panel of your chart, as are the volume bars. As you can see from the chart on the slide, it's not always easy to capture volume divergence. Now, can I just ask if anyone here uses volume divergence at all, especially in the FX market? I'd be interested to know what your results are, especially using tick volume. If anyone has used this or has any experience with this, please do let me know. We have one guy, Peter. How have you found that, Peter? Have you used volume tick bars as a form of divergence, and how have you found that? So look, on note of this slide, we in stocks particularly know just volume works well. Yeah, thank you, Peter. I agree. So look, in stocks, volume is generally watched to diminish in patterns such as flags and pennant formations. A gentleman who goes by the name of Thomas Bukowski, I think that's his surname, runs what's known as the patternsite.com and has performed extensive research regarding pattern formations and includes volume studies. So do check this out if you're interested. As you can see here, we have the price moving higher along with the volume moving lower, which as you can imagine, if price is moving higher on lower volume, this tells us that we have a potentially weak up move. The same here, lower volume, price is moving higher, and we have a potentially lackluster upside. Now, in terms of patterns, you may have noted a half-hearted bearish flag pattern here. This is not one I would really trade. Here is the pole to the pattern, but this is a bearish flag formation. And if you do visit the patternsite.com, where Thomas Bukowski has performed the research, you will note he says the higher probability patterns, I believe, do have declining volume within the pattern. So volume declines within the pattern. Okay. So if you prefer to view volume through an indicator, as most do, on balance volume, OBV, measures the buying and selling pressure as a cumulative indicator. What I mean by that is it simply adds volume on up days and subtracts it on the down days. OBV is a leading indicator, as far as I'm aware, for predicting price movements based on volume levels of security. Again, it's using divergence. I think most divergence signals are considered leading. In my experience, they are anyway. So look, as said, OBV is a cumulative indicator. So if the last closing price is higher than the previous closing price, the day's volume is called up volume. If the closing price is below the previous day's closing price, the volume is down volume. You can see a specific value on the OBV. Now, anyone here can correct me if I'm wrong, but the primary focus on, especially with the OBV indicator, is on the direction of the line. There's not much focus placed on the actual value. And again, if anyone knows any different, please do let me know in the chat box. So the direction of the line can tell you whether there is a buyer pressure or seller pressure in the market. The on-balance volume indicator potentially shows whether the market participants entering long the market participants are entering long positions or are accumulating the underlying asset, or whether the asset is being sold off. As can be seen from the chart, the indicator is clearly confirming direction from May to August, I believe. So as we have an up move through May to August, we have the indicator and price are in harmony. Until a moderate divergence signal is seen on the OBV, which coincides with a higher high on the in the price action. This, you know, this divergence signal here produced I think it's around a 400 pip move all in all. Obviously we wouldn't catch all of that, but what this does tell us is this small divergence signal here can tell traders to tighten trailing stops, for example. For those long at this point, you know, with trailing stops below here, you're going to get taken out. There's a high probability with a bearish divergence formed within an uptrend that price could potentially, you know, move lower. So this could, as I said, it could be time to tighten trailing stops in this case, to avoid leaving too much on the table, as they say. Okay, so one thing I've noticed, and please do correct me if I'm wrong, if anyone has more experience using this indicator, is we can also take note of the size of the swings through the indicator. So as you can see along with price movement, the lower lows on the indicator are particularly, I would say moderate, and they're nothing to be, it's nothing to get excited about or write home about. So with the indicator failing to print much in terms of lower lows, I would think that there is pressure to the upside, and as you can see, this did work out. You know, I have not run a back test on this. This is just something I've been noticing over time. So I was wondering if anyone here has any experience with this kind of analysis. So one more chart I was looking to touch on, and this is the Euro-Dollar H1 time frame. Now, for any Fibonacci traders here, we did recently hold a Fibonacci webinar recently. So if you're interested in Fibonacci studies, please do check that out on YouTube. But here you can see we have a divergence signal within with the OBV and the price action. But what was fantastic about this was we had a really, really nice support area formed of Fibonacci levels. Now, as you can see, we have the 100% Fibonacci projection, which comes in at 1579. We have a 50% retracement. Now, guys, do be aware, a 50% retracement is not a Fibonacci number. It is used, however, on many platforms, as they do tend to help form support. And with this, we also have a 61.8%, and that comes in at 15, if my eyes are not failing me, 1570-ish, and a 1.272% Fibonacci projection. So between 1570 and 1579, we have a 9 pip range of support, which held up nicely. And as I said, this Fibonacci support was confirmed by a divergence signal on the OBV. Now, I did check if the RSI did form a divergence signal similar to this, but it didn't. So this is something I would entertain, is something like the OBV along with an RSI signal. So if we have two diverging signals on the OBV and the momentum indicator, that would be something that would interest me, because they're measuring two different things, I guess, in terms of the market. Any questions on this chart? Any questions on the Fibonacci arrangements or anything like that? Please do let me know. One more point I just wanted to highlight is how can we confirm divergence on the OBV? Now, there is a way I've found is simply by drawing support and resistance. So here we can see, let me just draw this on so it's nice and clear for us all. I'll try my best to draw it well. We have resistance across here. So once the divergence signal has formed, we can look for a break of this resistance level at this point here, and this would help confirm the divergence signal seen here. Now, as I said, guys, any questions, please do feel free to fire away at this point. And this is the Q&A session. So we have one question. Can divergence signals be used on all time frames? For me, divergence signals are best used, I would say best used, but I've seen them work so many times on lower time frames. I do like the higher time frame signals, especially when they converge with lower time frame signals as well. But I'm more of a higher time frame trader in that sense, in terms of divergence. Have you ever used the MACD for divergence? I have used it, and I know the calculation pretty well. But you know, as I said in the presentation, I found that they gave off pretty similar signals. Maybe I didn't put enough time into it, but I'm a big RSI fan, so I guess I was kind of biased at that point. We have one other question here. What is your analysis on sideways consolidation on price versus the OBV? That's a good question. You know, if there's within sideways consolidations, you can still find divergence if that's what you're asking. You can still find divergence within the range area. So, for instance, look for bullish divergence at the range support extreme, and you know, and bearish divergence at the top of the range. But always do take trend into consideration. If you're trending higher, you don't really want to be. I would probably steer away from selling the range resistance within an uptrend, even if you have bearish divergence. But this is just me. Again, this could work for other traders, but it just hasn't really worked for me. One more question we have here. Would you ever base divergence as your prime signal? This is a very easy question. No, I most definitely would not. For me and most traders I know that use divergence as they use it as a confirmation signal more than anything. So as I showed during the presentation, this is simply you find a really clear-cut support and resistance level. This is just an example, a clear-cut support and resistance level, and once price touches that area, if we're forming bullish divergence, this helps confirm the area of interest. Does the price action tend to continue in the same direction, and this correlates on the OBV? Does the price action tend to continue in the same direction? Yes, so the OBV is very good for, if I understand the question correctly, the OBV is very, very good for confirming the price moves. As you may have seen on the chart, there's not many divergent signals that I could find with the OBV, concrete divergent signals. So it's very, very good as a confirmation tool as well, the OBV, if that's what the question relates to. Okay, brilliant. Excellent. So with that, that's pretty much all we have time for today. Thanks once again for taking the time to join me. I hope you are able to take something to walk away with this, walk away from this presentation more informed than when you joined. Look, the next webinar on the schedule is a multi-time frame technical analysis. Now, we'll go into divergence there. And I will also look at support and resistance and Fibonacci. I will really look at many technical components. And this is nearer the end of the month on Thursday, the 28th of October. Please be sure to send over any suggestions you have to marketanalyst.com, or as you can see on the slide, support@fpmarkets.com. Also, as I say in my webinars, please feel free to check out the FP Markets Trading Hub. This is packed with educational articles and analysis. We have one more question. Does our competition, the big banks, trade in this way, i.e. use divergence as one of their, I've spoken to a couple of bank traders, and I was surprised that some of them actually use Fibonacci. There's so much on the internet that's going to say I'm wrong here, and they don't. But I've spoken to traders, I've spoken to bank traders that used to be on the floors. Things have changed, I think. I recently had a conversation with an ex-bank trader, and I asked him how did they used to stop run, and it was exactly how I thought. They used to run the big numbers, but they said there's a lot more regulation now. But it's still, he said it does still go on, but it's not as limited. But he did confirm that they do look at Fibonacci levels and things like that. Whether they look at them in the same way as I do is very, very difficult to tell. But you'll find that many banks use a macro strategy. So I think macro strategy for direction, and then they use technicals as a way of entry. Okay, so with that, have a great day, and I'll see you all again very, very soon. Thanks, guys.